You think you're investing like Warren Buffett? You're not, and you're paying dearly. Let's dissect Vahan Janjigian's Even Buffett Isn't Perfect.
Imagine a split screen right now. On one side, the S&P 500, steadily grinding out returns for decades. On the other, Berkshire Hathaway, for many, the holy grail. Now add a third panel, your portfolio, the one where you dutifully bought Coca-Cola, Apple, maybe a bank or two because Buffett bought them. The harsh truth? That third panel often lags both the S&P and, in recent years, even Berkshire itself. You didn't just underperform, you often paid a premium for the privilege. Here's the kicker. Mimicking a legendary investor's portfolio without mimicking their circumstances is financial suicide. You're trying to wear Shaq's shoes to run a 5K. You aren't investing like a legend, you're tripping over giant shoes. That's you buying Coca-Cola because Buffett did, while completely missing the 1,000% growth in tech because you're role-playing a 90-year-old billionaire. Your boss isn't handing you private equity deals. Your side hustle isn't generating billions in free money to invest. This is the bleeding neck problem. You are, effectively, trying to buy insurance float strategies with a checking account salary. Think about that for a second. Buffett's real secret sauce isn't just picking great companies, it's the insurance float. That's billions of dollars in policyholder premiums that Berkshire Hathaway holds before claims are paid out. It's essentially an interest-free loan, often with no fixed repayment date, that he can deploy. Imagine getting that kind of capital injection every single day. You don't get that. You get paid every 2 weeks. You have rent, inflation gnawing at your savings. Your circumstances demand agility, not rigid mimicry. He buys deeply discounted multi-billion-dollar companies, sometimes acquiring them whole, sometimes making private deals you'll never sniff. You're left buying scraps from the public market, usually after the big run-up, paying full price, then holding for dear life because that's what Buffett does. But he's not just holding, he's deploying capital like a financial special forces unit, while you're standing guard at the same old gate. The bottom line is this: you cannot replicate a strategy that relies on unlimited, interest-free capital and private market access with your average 401k and personal savings account. It's not just different-sized capital, it's an entirely different game. If this hits home for you, drop a like, because next we're going to talk about how to invest like a shark, not a beached whale. How to capitalize on your advantages, not try to borrow someone else's. But the real problem isn't just what you buy. It's a hidden structural trap that forces Buffett to hold stocks he actually hates. I'll explain that next. The billionaire's handcuffs. You are constantly bombarded with advice to invest like the Titans. Be patient, hold forever, buy wonderful companies at fair prices. It sounds so simple, right? Like some ancient, sacred investing wisdom passed down from the mountaintop. Here on Audiobook Bites, we distill the best books into actionable insights, but nothing beats the original. Grab the book if you want the full deep dive. Today, we're peeling back the layers on The Billionaire's Handcuffs. Because honestly, the investing advice from a guy running hundreds of billions isn't just extreme, it's often irrelevant, even counterproductive for you. The core idea? Structure dictates strategy. This isn't just an investing mantra, it's a brutal reality in office politics, in launching a side hustle, and absolutely in managing your personal finances. What works for a titan like Buffett, who wields unimaginable capital, actually imprisons you if you try to mimic it. Let's dissect this with brutal honesty. First up, the liquidity trap. Think of a crowded theater. The fire alarm blares. You, as one person, can slip out the side door unnoticed. You can adapt, pivot, change your mind. Buffett, he's an elephant in the room. If he moves, he crushes the furniture. If he sells a major position, say billions worth of Coca-Cola, the market implodes that stock's price. He cannot exit without causing a seismic event, destroying value not just for other shareholders, but for Berkshire Hathaway itself. His very size locks him in. So when he preaches holding forever, understand this. For him, it's less a virtue, more a necessity, a gilded cage, a strategic straitjacket. He must buy companies he's comfortable holding indefinitely because he literally cannot get out easily. For you, this hold forever mentality can be a dangerous prison sentence for your capital, especially in a volatile economy, grappling with persistent inflation that eats away at idle cash. Your flexibility, your ability to sell in a millisecond, is your superpower. You can reallocate funds to seize a new opportunity, pay off high-interest debt, or pivot your side hustle. Buffett doesn't have that agility with his mega positions. Don't surrender your greatest advantage trying to emulate an elephant. Next, let's confront the stark difference between controlling interest versus minority shareholder. Buffett doesn't just buy stocks, he often buys chunks of companies big enough to demand a board seat, influence management, sometimes even dictate strategy. He's not a passive investor waiting for the stock to tick up. He's an active fixer, a hands-on owner. He can initiate massive share buybacks, greenlight a new CEO, or approve a major acquisition. He reshapes the business from the inside. You buy 50 shares of Google. You're a passenger, a hopeful, grateful passenger perhaps, but a passenger nonetheless. You hold zero sway. You cannot demand management changes. You cannot force a spinoff. Your only power is to buy or sell. Buffett's unfair advantage isn't just his capital, it's his capacity to fix the companies he invests in. He's the executive producer and lead actor. You're an extra, hoping for the best take. You're betting on the jockey. He is the jockey, the stable owner, and often the track manager. This chasm in power leads us to the insidious cult of personality tax. People see Buffett's name attached to a stock, and suddenly it gains a halo. They pay a premium for it, often justifying higher valuations with, well, Buffett bought it. This isn't shrewd analysis, it's blind hero worship. You're paying extra for a stock just because he touched it. The market prices in this perceived seal of approval, which actively reduces your potential upside. It's like buying a used car at a premium because a celebrity once owned it, even if the engine's the same and it performs identically to a cheaper model. That premium isn't free. It's a real cost, a tax on your blind faith, a drag on your returns. And it means you're often buying at the very peak of enthusiasm, just like in office politics, when everyone flocks to the boss's pet project right before it gets restructured. He champions patience, but that patience for him comes with levers you don't possess, information you don't access, and a market impact you never will. His strategy, yes, but it's a strategy born from and constrained by his monstrous scale. If this hits home for you, drop a like. The bottom line is, your structure is nimble, his is titanic. Your strategy must reflect that reality. Don't hobble yourself with his constraints. So, if we strip away the hero worship, how does a shark actually value a company? It turns out most of you are reading the PE ratio completely wrong. Stop buying cigar butts. You've been told to hunt for bargains, right? To seek out the undervalued gem? You see a stock like Ford or AT&T trading cheap, you think, finally, a steal. It's practically free money. No, stop. That's not a bargain. That's a trap. It's a cigar butt. Soggy, gross, likely picked up off the street, and maybe has one pathetic puff left before it burns your fingers. You've been conditioned to scour the discount bin. We are ripping that strategy up. We are switching to the Apple mindset. Expensive? Maybe on the surface, but does it print money faster than inflation eats your salary? Yes. That, my friend, is the new value investing. It's about quality, not just price. Now, let's get controversial. Your investing gurus, your Ben Graham acolytes, they're still preaching yesterday's sermon from a dusty, forgotten playbook. Because even Warren Buffett, the high priest of value, the man who practically wrote the book on cigar butts, he abandoned that strategy decades ago. He stopped salvaging forgotten companies for a single desperate puff. He now acquires entire forests, companies with endless, high-quality timber. Why do you think he owns Apple, for crying out loud? Not because it was cheap. It wasn't. It's because it prints money, consistently, reliably. While everyone else frets about market corrections, Apple just keeps funneling cash. He evolved. So must you. Here's a critical, often painful shift. Most investors marry their stocks. They fall in love. They become emotionally attached, riding a losing horse because it has to come back. It's a foundational company. That's like staying in a soul-crushing, dead-end job because it's comfortable or it's what I've always done, while inflation systematically erodes your purchasing power and your ambition. This strategy demands agile diversification, no emotional baggage. You buy companies that perform. If they stop performing, if their story changes, you divorce them, swiftly, brutally. No sentimentality about your capital. It's a tool. Use it to build wealth or watch it rust. Now, let's talk numbers, because this is where most people crash and burn. You've been trained to chase a low PE. Oh, look, the company's cheap. That's often a mirage, a financial trap that ensnares the unwary. A dirt cheap PE can scream one thing: the market knows something you don't. Maybe the company's a decaying asset, a zombie just shuffling along, generating barely enough cash to keep the lights on. Your new radar? Return on equity, or ROE. This metric reveals how efficiently a company uses your money, the shareholders' money, to generate profits. Think of it like a side hustle. Do you want a side hustle that costs a fortune to run, demands all your free time, and barely breaks even? Or one that consistently generates solid returns with minimal fuss, a true profit center? High ROE companies are the latter. They're money-making machines, not bottomless money pits. Here's the kicker, and this shatters traditional value thinking. Your old mindset likely gravitated towards cheap physical assets. Look at all that property. Look at that massive factory. Think of the liquidation value. But what if those assets are producing dwindling returns, becoming liabilities rather than strengths in a rapidly changing economy? This new approach prioritizes pricing power, what Buffett calls the moat. Can the company command higher prices without losing customers? Can it pass on inflation to you, the consumer, and still thrive, maintaining its margins? Think Apple raising prices on iPhones year after year, and people still line up? Think Starbucks increasing coffee prices, and your morning commute still demands that venti? They have pricing power. They possess a competitive moat so wide, it's practically an ocean. This isn't about what they own, it's about how much leverage they have over their market, over you. That's where the real wealth accumulates, not in bargain bin inventory or rusting machinery. That's financial dominance. If this hits home for you, if you're tired of picking up financial cigar butts, drop a like. But finding good companies is only half the battle. You need to know the exact price where a good company becomes a bad investment. Let's fix your math. The safe stock trap. You probably think the 10-year Treasury bond is the gold standard, the risk-free rate. It's foundational. Every major financial model, from your dusty textbook to Wall Street's algorithms, anchors its valuations to this seemingly bulletproof concept. They assume a percentage return you could get without breaking a sweat, a return with zero risk. Here's the brutal truth. For your money, for your portfolio, the risk-free rate is a lie, a dangerous, seductive myth. It shatters the very foundation of how you should value investments. Think about it. Can you buy a stock, any stock, and guarantee a return equivalent to a treasury bond? Can you ensure that company won't suddenly pivot into NFTs or a metaverse project that incinerates billions? No, you absolutely cannot. The entire premise that you can simply add a tiny equity risk premium to the treasury rate and call it a day, that's Wall Street gaslighting you. Now, let's get controversial. Warren Buffett doesn't sweat an equity risk premium. He doesn't bolt an extra percentage onto the treasury rate to discount his cash flows. Why? Because Buffett treats buying a company like buying a treasury bond, because he controls the CEO. He doesn't just buy shares, he acquires the decision-making power. He dictates, he commands. You don't. If the CEO of the company you own decides to blow billions on a speculative metaverse project, you lose. If they launch a disastrous new product line, you bleed. We need to price in that potential stupidity, that lack of your control. We are adding a stupidity tax to our valuation models. This is where your mortal's premium stomps onto the scene. You, the busy commuter, juggling side hustles and inflation, you must demand more. When you discount a company's future earnings back to today, don't just use some theoretical 10% discount rate. You bolt on an extra 5% to 10% for safety. This isn't optional, it's self-preservation. Let's do a quick calculation. Think of it as calculating the price of uncertainty. Imagine a company you're eyeing. It promises to churn out $100 million in free cash flow exactly 10 years from now. If you use a typical institutional discount rate, say 10%, that $100 million is worth about $38.5 million to them today. Sounds decent, right? But now, you apply your mortal's premium. You add 5% to that rate, demanding a 15% return, because you don't control the CEO. You don't have perfect information. You carry all the individual investors' inherent disadvantages. At a 15% discount rate, that same $100 million 10 years out, it's suddenly only worth about $24.7 million to you today. That difference, that almost $14 million haircut, that is the price of uncertainty. That's your stupidity tax. That's your non-negotiable buffer against corporate folly, against economic headwinds, against your own lack of control. It slashes the perceived fair value, forcing you to buy only the most undeniable, robust businesses. If this hits home for you, drop a like. Seriously. Now that you have the theory, let's look at your Monday morning to-do list. Here is exactly how to structure your portfolio this week. The shark strategy. You're staring at that brokerage app again, scrolling past the same numbers, the same red indicators. That one stock, down 40%, stubbornly anchored in your portfolio. You're holding it until it comes back. A phantom limb of a good idea you once had. Stop it, right now. That's not a strategy, that's sentimentality, and sentimentality doesn't pay the mortgage. We're not here to collect vintage assets, we're here to compel growth. Today, we are unleashing the shark strategy, your Monday plan to weaponize your liquidity advantage. This isn't about hoarding, it's about deploying capital where it dominates. Forget everything you think you know about being a long-term investor if long-term means indefinite loss holder. We are redefining long-term as strategically ruthless. First up, and this one will sting a little, Step 1, audit your portfolio for zombie stocks. These are the investments you're holding purely for sentiment, for the phantom hope they might resurrect, or because you just can't bring yourself to admit you were wrong. Honestly, the offer's a bit dramatic here. Calling them zombies implies some kind of undead malevolence, but the core truth hits hard. If a stock exists solely because you're too stubborn to sell it, it's a dead weight. It's a wasted opportunity. You know the one I'm talking about, the company that peaked 5 years ago, whose product line looks like something out of a late-night infomercial now, and whose management team seems to be playing musical chairs with investor money. Cut it loose. Harvest that tax loss. Free up that capital. You are a shark. You hunt opportunity. You don't curate a museum of past mistakes. This single action liberates your mental bandwidth as much as your actual cash. Next, we execute the thesis check. This isn't just some fancy Wall Street jargon. This is about asking, did the story change? And if so, why are you still reading the same chapter? Remember that promising startup selling artisanal dog treats that was supposed to revolutionize pet ownership? Great story. But then inflation shredded their profit margins, and a major competitor started offering organic options at half the price. The narrative shifted. The original investment thesis, the reason you bought it, crumbled. You must be ruthless here. If the fundamental story that attracted you to that stock in the first place has mutated or collapsed, you must sell immediately. Don't waffle, don't wait for a miraculous rebound. Use your liquidity, that sweet, potent cash, and move it. Relocate it into a high ROE compounder, into something that's actually working right now. Think about it. That money sitting in a dead stock, it's not just stagnant, it's actively losing purchasing power thanks to current inflation, while new opportunities scream for your attention. This isn't personal, it's just smart business. Now, let's get controversial for some of the old school thinkers out there. Step 3. Apply the tech filter. Here's where some of the author's advice shines despite their often overstated rhetoric. Don't dare ignore innovation just because Warren Buffett famously whiffed on tech in 2000. He made billions elsewhere, sure, good for him. You, however, are not Warren Buffett. You don't have a multi-billion-dollar float funding your investments. Your advantage is agility. Your edge is being able to adapt faster. The world runs on tech. From the algorithms powering your side hustle's marketing to the AI revolutionizing office productivity, technology drives every sector. To dismiss it as too complicated or too volatile is to voluntarily blind yourself to the most powerful growth engine of our era. You must understand and allocate to companies that are not just participating in innovation, but actively shaping it. This isn't about chasing hype. It's about identifying the structural shifts that will redefine entire industries for decades. Ignoring this is akin to ignoring the internet in 1990. You just can't. Finally, and this is non-negotiable for a busy commuter like you, set stop losses. This is the ultimate self-defense mechanism that Buffett, with his bottomless capital, simply doesn't need. But you must. A stop loss isn't a sign of weakness, it's a declaration of discipline. It's your automatic eject button when a position goes south beyond your predetermined risk tolerance. Let's be real, you're not spending all day watching tickers. You've got actual work to do, office politics to navigate, and maybe even another side hustle keeping you up at night. You can't afford to let a bad investment decimate your gains because you blinked. Define your maximum acceptable loss before you even hit buy. Then set the order. This isn't speculation. This is preservation. This ensures your liquidity, your lifeblood, is protected and ready to be deployed elsewhere instead of being eroded by unchecked losses. It forces you to be as pragmatic as you are bold. If this hits home for you, drop a like. Seriously, this isn't passive investing, it's active wealth fortification. You are not a bystander. You are the architect of your financial future, and architects don't leave structural integrity to chance. Before you go buy the book, wait. There are 50 pages in here that are absolute trash, and I need to tell you what to skip so you don't waste your time. Read it or burn it. You're tired of the financial gurus, aren't you? The ones who promise secrets but deliver fluff? Good, because we're about to slice through the noise with Vahan Janjigian's The Worst Case Scenario Survival Handbook for Wealth. And believe me, it needs a good slicing. This book, it's a mixed bag, like finding a single, perfectly ripe avocado in a dumpster full of rotten fruit and yesterday's newspapers. Most of it, honestly, is refuse. But that one perfect avocado, that's what we're digging for. First, let's talk about the BS filter. Janjigian spends way too much time yelling about politics in this book. Seriously, you'll find page after page devoted to taxation policy, the Federal Reserve's supposed blunders, and who's really to blame for the economic woes of 2008. If you wanted a political podcast, you'd be listening to that, not this. Your ROI doesn't care about their partisan screeds on tax brackets. Your personal portfolio isn't swayed by a politician's platform. This isn't a civics lesson. It's about making your money work harder for you. This political diatribe, it's like that coworker who constantly blames management or the system for their missed deadlines, but never actually does the work. Just ignore the noise. You're here for actionable intelligence, for concrete steps that boost your bottom line, not a soapbox sermon. Your mission isn't to fix the national debt, it's to fortify your personal wealth. These sections drain your mental energy without delivering a single dime of added value. Don't fall for the distraction. They divert your focus from what truly matters. Next, the time capsule warning. Look, Janjigian penned this after the 2008 financial crisis. So, naturally, he peppers the text with specific stock picks and investment strategies hyper-focused on that particular economic climate. And honestly, they're as relevant today as a Blockbuster membership card. We're not buying shares in companies that peaked 15 years ago, are we? We're not investing in a market that no longer exists. This isn't a history lesson on past market performance, it's a blueprint for your future performance. Don't get sidetracked by dusty financial history. Your market is today's market. Your opportunities are right now. It's like getting cooking advice from a 1950s cookbook. Sure, the basic principles might endure, but do you really want to serve a Jell-O mold and liver pate for dinner? His specific picks from 2008 are just that, specific to 2008. They trap you in a bygone era. They obscure the timeless principles that actually drive success. Your goal isn't to mimic a past success story. It's to forge a new one based on current realities and future potentials. Discard these outdated specifics. But here's the kicker, the absolute, undeniable holy grail of this book, Chapter 4, Structure Dictates Strategy. This chapter alone, it's worth the price of admission. It truly shatters the myth of hero worship in investing. It demolishes the often fatal idea that you can just copy Warren Buffett's portfolio and expect similar returns. Why? Because Buffett operates under a completely different structure than you do. He runs an insurance conglomerate. He has access to immense float, basically free money that he can invest. He has insider access to information, to capital markets, to political leverage that are light years beyond what an individual investor can ever access. You don't have Berkshire Hathaway behind you. Your side hustle, your 401k, your personal savings, that's your structure. Vahan Janjigian spends way too much time yelling about politics in this book. Unless you're running for Congress, skip it. But the chapter on why you shouldn't copy Buffett's portfolio, that is the holy grail. Buy the book, read Chapter 4, and then get back to work. This isn't about what Buffett buys, it's about why he buys it given his unique structural advantages. Here's what you need to internalize. You must understand your structure. What are your inherent advantages? What are your avoidable limitations? This chapter empowers you to stop chasing shadows, to stop playing someone else's game. It forces you to look inward, to build a strategy that works for your life, your capital, your risk tolerance, and your specific financial goals. Your inflation concerns, your daily grind, the realities of your office politics, your personal financial runway, these are your realities. Understanding your structure is the bedrock of your success. This realization, it changes everything. It's the difference between trying to play professional basketball when you're 5 feet tall and completely dominating your local pickup league. Play your game. Own your game. So, the final verdict? Burn the political rants, skip the outdated stock tips, but absolutely buy this book for Chapter 4. Read it, reread it, internalize it until it becomes second nature. If this hits home for you, if you're tired of the endless hero worship and ready to take control, drop a like right now. Because if you want to stop worshiping heroes and start making money, you need to understand your game, not theirs. Subscribe if you're ready to command your own financial future, to disrupt outdated advice, and to unlock your real wealth potential. Stop dreaming, start doing.